My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. This market keeps climbing an immense wall of worry. That's one reason the rally won't quit. Even if we occasionally get some sedate days like today, Dow advanced 55 points, and S&P declined 0.08%, NASDAQ did 0.22%. I bring up the wall of worry because we have a huge number of strategists who came out this very morning offering all sorts of mumbo-jumbo about what the companies, the S&P 500, could earn in the aggregate and what we should pay for those aggregate earnings. Hey, good exercise, but to take a top-down approach based on the macro, while I prefer to focus on individual companies. It is Mad Money. We like companies. We like stocks. For example, perhaps the most ferocious brick in the wall of worry is the bond market. Every day for months, we came in and watched the bonds. If they were going down in price and up in yield, and most of the time they were, we knew that stocks were toast. We had a stunning ramp up in Treasury yields that seemed endless. It was torture.
The house of pain.
Everyone wanted to flee the stock market for bonds. They just didn't know if they should buy bonds now or even later, when presumably, of course, the yields would be even higher. And then the unthinkable happened. Treasury yields hit a wall. And then they actually went down. We got a later report that it didn't show great wage inflation, which made us feel a lot less worried about that recent red-hot 4.9% GDP growth number. Then the Fed made it sound like it was an open question whether they'd hit us with more rate hikes. And the Treasury said they planned to sell far fewer long-term bonds than people expected, taking care of the problem on the long end of the yield curve where there was a giant glut. Next thing you know, bonds soared in price and plummeted in yield. Of course, if rates are peaking, then forget bonds. You just need to own stocks. Just remember the dictum of the late, great Marty Zweig, one of my investing idols, who said, don't fight the Fed. If the Fed's raising rates and you buy stocks, you're fighting the Fed. If the Fed's done tightening and you own stocks, then the Fed is your friend. Buy, buy, buy. If the Fed's going to cut rates, then it's a lovable bull that anyone can ride. So you get a phenomenon where bears convert to bulls en masse like they did for tech last week, and when that happens, there just isn't enough stock to go around. It just disappears at the top. That's why you need to anticipate their buy, meaning you need to anticipate the Federal Reserve's next move. I'm not saying you should wait until it's safe for the Fed to cut rates. You just need to feel confident that they're done tightening. I think the data we're going to see this week, including tomorrow's CPI, will make it clear that they've more or less won the fight against inflation, which means they're no longer fighting the bulls. Second worry, the war between Israel and Hamas has the world on edge. The murderous rampage in Israel, the humanitarian crisis in Gaza, the hostages who it seems like everybody's forgotten about, the inability to keep civilians out of the crossfire in a counterinsurgency operation. It's all awful, every bit of it. We're all waiting to see how wide this conflict gets, and our government's very much involved, carrying out another round of airstrikes against targets tied to Iran and Syria. Apparently, we need to protect our outposts in Syria. Not that anybody knew we had outposts in Syria a month ago. I know this can be a divisive issue, but people care about it a great deal, and they find it impossible to believe that a war in the Middle East doesn't impact our stock market. However, the market's really all about earnings and interest rates. Right now, the conflict isn't impacting earnings, as Gaza is too small and economically inconsequential. It isn't impacting bonds either, because it hasn't done anything to oil. Saudi Arabia and Russia haven't stopped pumping, and our country's producing crude in record amounts. You can't expect the bond market to be worried or sad because people are dying. The bond market's a tin man. Don't ask it to have a heart. Then we had a giant piece of the wall of worry called earnings. Given that the Fed seemed like it was on the verge of causing a hard landing, many believed earnings season could be just an unmitigated disaster. It would be the so-called last good quarter. There were plenty of bears shorting pretty much everything, just as they're still shorting Target and Home Depot and other retailers that report this week. I can think of a host of stocks that were heavily shorted going into earnings. My favorite to watch, of course, is Apple, one of my two own it, don't trade it situations. The other is NVIDIA. New chips announced today from NVIDIA. Now, how did people feel about Apple before the quarter? Why don't we just use a real-life example to make it clear? On October 3rd, KeyBank downgraded the stock of Apple. They said the valuation was too high versus historical levels. To me, that meant nothing because Apple used to be a hardware company, but now it's got a huge service revenue stream that's nearly bigger than wearables, iPads, and computers put together. U.S. sales were supposed to be struggling. International growth was suspect. Both came out kind of true. But you see, they weren't disasters. Plenty of countries had record sales. Apple did great in China's biggest cities. Everybody was terrified that business would collapse thanks to a poorly understood government crackdown on iPhone users. But Apple actually gained share in China. Gained share. Yet in the end, the quarter was much better than feared. If you sold the stock beforehand, well, you did have this chance to buy it right post-guidance, but the window closed very quickly. Memo to Brandon Nispel, CFA at KeyBank. You come at the king, you best not miss. Finally, you have the brick of worry that is Washington, which feels like it should be a huge bear coming right at you. They know nothing! Washington doesn't like China. Washington spends like a drunken sailor. Washington regularly wants to shut down the government with temper tantrums that remind me of my children when they were 5, except my kids got horse sense. Washington should bring everything down. But here's the thing. The key pain points with Washington, too many government bond auctions in the last year's Cold War with China, simply didn't pan out negatively. The U.S. Treasury figured out that it should issue far fewer long-term bonds than people expected, creating short-term short squeeze. As for China, all of a sudden, President Xi's coming to San Francisco, and President Biden's going out to meet him. Well, that doesn't sound like a prelude to war to me. It's you? Although the Communist Party has had a nasty habit of reneging on pretty much every promise it makes to us. Here's the bottom line. There are a ton of other bricks in the wall of worry. But the ones I just mentioned are the ones that were supposed to cause us to stumble and fall. Turned out the bricks couldn't stop the bulls. I'm sure the wall of worry will be rebuilt again. Right now, though, it is just what the bull vet ordered. John in New York. John.
Jim, my question is regarding a beauty stock whose chart is not so beautiful. With exposure to China, what are your thoughts on Estee Lauder?
Estee Lauder is a disaster. We have a conference call on Wednesday for the club, and I will once again say, look, it was a terrible stock. It used to be a great stock, and I think Fabrizio Freda is not doing a good job, and they've got the wrong lineup. So I think that the answer is I can't ask you to touch it when I'm going to slam it on Wednesday. Yeah, Wednesday at noon. How about Paul, my old home state of Pennsylvania? Paul.
How you doing, Jim?
I'm doing well, Paul. How about you?
I'm doing good. I have a question on Dine Brands.
Sure.
D-I-N.
Yeah, you see, the problem with Dine Brands, we have a bifurcation in the restaurants. There's Chipotle, okay, and there's Brinker, and there is Darden, Texas Roadhouse, and then there's a lot of others in the lower end that are just doing terrible, and Dine Brands is one of them. I don't know what to make of it other than I don't want to be in it. It's just not what I'm looking for because it doesn't have growth. Let's go to Elizabeth in Florida, please. Elizabeth.
Hi. Happy holidays.
Oh, thank you, Elizabeth. Same.
I just wanted to know, what are your thoughts overall for ServiceNow?
ServiceNow hit an all-time high today, and you know what? It should. They are one of the few companies that has actually used artificial intelligence and made money. They got some amazing federal contracts. They are in a lot. I saw Jensen Huang speaking with Bill McDermott. It was fantastic. I think Bill's doing a great job, and I think the stock deserves that. I wish it were down a little so I could tell you bye, bye, bye. Let's go to Charles in Connecticut, please. Charles.
Hi, Jim. I'm calling you about AbbVie. I was trying to get an idea of what your thoughts on that were.
Right, so the problem with AbbVie, they do have a bit of a hole. I think they're trying to make it up, but they have a Humira hole. That's that's the greatest selling drug of all time. In order to make it so that if there are biosimilars that make it so that there's competition, they have to migrate people to new drugs. I think they can do it, but I really like to hear from them to come on the show because they are in permanent quiet period. And it makes no sense given the fact that they have a lot of people's money that they're managing. So it by being the owners of the company. So I do invite them on, Mr. Gonzalez, right here next week. Come on, say yes. All right, it turns out that the most worrying bricks in the wall of worry could not stop the bulls. No, no, no. I'm sure the wall of worry will be rebuilt. We're going to have to scale it again. Right now, it's just what the bull vet ordered. Oh, Mad Money tonight. We were lucky enough to be joined by some of West Point's finest in a special Veterans Day show last week, and we had some amazing questions from cadets that we're taking more of them because, boy, you can't just put these guys down. They are too fabulous. And how much have they done to serve our country? Then oil's been clobbered the last few weeks, so what could the end of the year hold? And what impact could it have on the stock market? I'm going off the charts to find out. And F1 is heading stateside ahead of this weekend's Las Vegas Grand Prix. I'm getting an inside track on the state of the business from our own Sarah Eisen ahead of CNBC's documentary that premieres this Thursday at 8 p.m. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.